Hi, everybody. Welcome to another KE Report webinar. We have quite a cast of characters, I would say. We have Chris Temple, Al Corlin, Big Al, and Richard Postma, aka Doc. We have all of our webcams up and running. We don't have any presentations per se or any slides to present, but if we do bring up any charts, I will be sure to post those on the screen so people can follow along with everybody. And again, I want this to be more interaction between everybody. So if anybody has a question, you should have an option where you can post either, I think it's more of a chat board, but you can also message me directly, and I will keep an eye out for questions so that I can stay on top of everything and what everybody wants to talk about. We already have had a couple questions that were emailed to me. I appreciate people doing that ahead of time. But first off, this general topic that we wanted to cover is the investing climate around now a Trump presidency. It seems like a lot of the pundits had it completely wrong when they said gold would pop $100, the U.S. markets would collapse. We have not seen that. We saw actually them be right for about an hour and a half in the middle of the night, and then everything reversed. So to start it off, Chris, I want to throw it over to you because you and I did introduce this webinar a couple days ago, and we appreciate everybody who managed to sign up and join in right away. But Chris, your take on what investors need to be considering now that we do have clarity in the presidential election, and we've already seen some of the moves that have started to happen.
Well, a couple things quickly at the outset, Cory. First of all, as I say from time to time, we need to be prepared every now and then to go and revisit our own theses. You know, what do we see for the future? What are the markets telling us? What are the charts telling us? What's the fundamentals telling us? And now, of course, added to the mix is what is a dramatically changed political landscape telling us, and move accordingly. We're going to talk about that tonight, folks. Secondly, understand that for the last 48 hours nearly now, we have seen moves in markets that are, in some cases, loony. It wasn't that long ago that if you had suggested to just about anybody that we would see the U.S. dollar screaming higher with the U.S. dollar index nearly at 100 again, Treasury yields really surging higher. I mean, from 171 overnight when the risk off attitude was at its peak to now 215 or thereabouts today on a 10-year note. Massive move that we haven't seen in a long time. And that yet at the same time, we would see copper at 250. We would see the stock market in the forms of the Dow setting a new high today, although you have to put an asterisk next to that. You'd think that that was crazy, but we've had those moves. They're not all going to last, not in unison like that. If they do, gold bugs are in real trouble, I'll tell you that much, because what a lot of people are trying to sell right now, and I think it's kind of an excuse, is that, well, this now is going to be Reagan redux. We're going to see a lot of the same stuff we did during President Reagan's early term, maybe a little bit of rockiness economically, but for the most part, we're going to have a situation where we have great growth, tax cuts, deregulation of different things, and the stock market's going to go gangbusters. I think we might get a light version of that, but that's what people seem to think that they're betting on right now.
Well, I think what is interesting is seeing some of the moves in the markets that are pointing towards a rotation in the markets too. We've had the NASDAQ move down, but then the money has moved into the S&P, the Dow. The tech stocks have been sold off, but we are seeing, as you said, some base metals moving up. Doc, it's something you and I chatted about at the market wrap today, was that it seems like investors are looking forward to infrastructure spending, and markets always look ahead. These movements that we've seen, do you think that they're getting a bit overdone? Because there have been some pretty significant moves very early on, right after the election has been settled.
Yeah, I feel, Cory, that this is all anticipatory. It's looking ahead. And everybody was concerned when Trump was elected early or the pre-election that night when the election was going on. You saw a huge move down in the stock markets. But boy, have they turned around, because I think people are starting to anticipate the potential here in the first 100 days. And not only from infrastructure spending, but if you look at his policy website, he's talking about repealing Obamacare, which if he does, it's going to be a boon to the middle class as far as loosening up money that they're having to put into these instruments right now that they will now have in their pocket, hopefully. That's the second program that could be stimulatory to the economy. A third one, and this is where Wall Street loves it, they're talking about repeal of Dodd-Frank. Now, I have a little problem with that. I hope we don't go back to where we were and let these people loose again with their financial instruments. But so Wall Street is very happy with what they're seeing. But this is all anticipatory, and when the emotions calm down again, I think the markets will calm down again, like Chris mentioned.
Now let's talk about this potential repeal of Dodd-Frank, because I think that is a crucial topic that if Trump does go through with something like this, it again changes the financial network and the rules and regulations around what banks can do and around what investors need to consider. Who wants to take this one?
You know, I got to tell you, talking about Dodd-Frank, I was amazed when Dodd-Frank was passed in the first place. It's not a good idea. It never has been a good idea. Banks have a specific purpose that they need to do, that they need to fulfill, and being involved in that particular business that Dodd-Frank allows them to be involved in, I think is really, really incorrect. It's not good, in my opinion, for capitalism. It's not good for the people. I would go on one step farther, and I would say I agree with what you guys are saying about, you know, the markets, etc. I really question the fact, though, that are the markets going to slow down, Doc? I personally think it's going to be a while before they slow down, and the only reason I say that is everything that I'm reading, all of the pundits are basically saying this guy is really going to be good for U.S. equities. I have to agree with that 100%, and it's only going to get reinvigorated if he, or if I should say the government, announces that they're going to get into infrastructure spending, which I think they really have to. Then that, I think, is going to be another thing that's going to make the markets take off. You get one business that has relocated offshore and somehow get them to come back, what effect is that going to have on the market? It's going to be huge. There's just so many positive potentials out there.
So I thought people were saying that Trump was going to be bad for business and bad for
I never said that. I don't think, Chris, you ever said that.
No, I don't think that's the case. Let me go back to your original question of Dodd-Frank, Cory. One of the things that people need to keep in mind as the backdrop to this, we have a world where the debt load is so great today that the ability of organic growth in all of the major economies pretty much can't even hardly keep up with interest service anymore, debt service. Forget about ever paying anything off. So as I've pointed out a few times recently to my own members and when we've had these discussions, there has to be some mechanism whereby the financial system in one way or another has got the justification and the ability to go, maybe not go back to turn Wall Street into any more of a casino than it already is, but to find some mechanism to drastically drive new credit growth again and drive the velocity of money. That's part of the reason why you've got a lot of people pushing the repeal of Dodd-Frank. The interesting thing is, in that regard, Hillary Clinton probably would not have gotten away with that type of a thing politically. Donald Trump is likely to do so, because we're going to get beat over the head incessantly in the coming weeks and months with, look at what happened under Reagan. We had tax cuts. We had all of this and that and the other thing. We unleashed the great American economy. We unleashed the great bull market. Yeah, and the deficit was 5 times higher under Ronald Reagan than the worst levels under Jimmy Carter by the time he got all done. But we're gonna hear this endlessly, and believe you me, they're gonna gut what's left of Dodd-Frank. They're gonna do a whole lot more to drive this new credit growth that they desperately need.
And you know, Chris, the point about Reagan, it was a whole different time back then. You had normal supply and demand economy. You don't have the debt we do today. And for them to really stimulate this from many different areas, there's potential for a real catastrophe because your deficits could potentially just explode. And that's my whole concern about some of the things they're talking about. And I can see we need more credit expansion with Dodd-Frank being repealed. But to allow what you said happen again, the casino effect, that's very dangerous in light of a huge debt structure of $20 trillion right now, as far as I'm concerned.
You know, Cory, we keep mentioning on the show, you know, you've got to stay nimble and you have to stay well informed. And I think that right now that is absolutely critical. And I think a lot of people put the U.S. debt, not necessarily listeners on our site, but a lot of the mainstream America puts the debt load kind of under the rug. They don't want to think about it. They don't want to talk about it. Quite frankly, honestly speaking, most people don't even understand what that means. They just figure everything is going to be okay. Mom and Dad are going to increase my allowance so I can go ahead and keep my spending patterns going. That's not going to happen. I mean, Chris, to me, it's terrifying what's going on with the debt load right now because, as you very astutely brought up, you know, you raise interest rates and it's not serviceable anymore.
Well, and this is where things are very curious in the last few days. And again, people need to understand that virtually all of what you've seen these last couple of days has not been living, breathing people like all of us in this conversation that made a decision, okay, I want to do this because this is what President Trump was going to do. You got a little bit of that. By and large, you had computer programs and algorithms that as soon as they saw a couple of states flip about midnight or give or take a little bit 2 nights ago, you had everybody shifting way over to one side of the boat. Gold was up $50-some an ounce. The Dow was down 800 and some points in the futures. And then all of a sudden we lurched back the other way because everybody got caught with their pants down and said, uh-oh. Now we have a Republican president, or sort of one, I guess, with the Republican Senate, Republican House. Oh, my God, I bet wrong. And they all had to jump back the other way. The jump in interest rates is going to be interesting because here you've got, this is going to be one of the more interesting things to watch because you've all heard that old saying of, what is it, an irresistible force meeting an immovable object or something like that.
Yeah, that's physics, Chris.
Yeah, and that's what you're going to have. Because at some point, this spike in long-term interest rates becomes self-limiting. The question is at what point? Now, the maestro, Alan Greenspan, who is the cause of all of this misery that we have financially in the world today, he was the monetary mad scientist of all time. He said on CNBC this morning that we need to get back to something like normal, 3 to 5% on the 10-year Treasury. If we get up there, we got real serious problems. So you're right that we can only have so much of a rise in interest rates before everything starts to have a problem. I mean, we already have had in the recent past an economy that's starting to bog down. Auto sales have rolled over, even restaurants that were strong for a while. And what a lot of people seem to be assuming, if you look at the stock market activity, is that, oh, good, the Republicans kept the Congress, Trump is president, now I can go out and buy all the stuff that I planned on. Did you see everybody beating down the doors at Wally World as if it was a day after Thanksgiving today?
It's a good point there, Chris.
I know Doc was heading down that way.
There's also another comment that came in from Jim here that said, part of Dodd-Frank cost businesses a ton of money in paperwork and overhead. So that, I guess, can also help businesses if we get rid of Dodd-Frank. Another comment that was made by LPG is consider this apparent 15% tax rate for corporations. So it does seem like Trump does have business in mind.
Yeah, and that's another one that LPG brought up, and I think it's a good one. That's also stimulation to the max. And also the comment about the paperwork, especially for smaller commercial banks, it was a killer. And I feel they should look at Dodd-Frank and repeal those things that have been a negative to the small banks, that sort of thing. But I don't think they should repeal the whole thing because you do not want another casino effect with the kind of debt we have today. And they're talking about letting them mix funds again to allow them to use depositors' funds to play their games again. I think that's very dangerous, and I hope they have some sense and don't go whole hog in one direction, because it's just, to me, going to create another huge bubble. And then I think that's probably the last bubble we're going to see before we really have difficulty.
Hey, Gary says bring back Glass-Steagall. What do you think about that, Chris?
Well, the reason why Glass-Steagall was repealed when it was, President Clinton late in his term signed that. It had been pushed by the Republicans. It had been pushed very, very hard by Alan Greenspan, who I just referred to, is for exactly the same reason, relaxing things now. Every time they find a different way to stimulate things with more debt, more financial alchemy, and so forth, and it starts to run out of gas, they've got to come up with something new. Otherwise, everything dies. That's what you have with the fractional reserve system. So, yeah, theoretically, we shouldn't allow a lot of this stuff. Theoretically, we should have a Tobin tax on financial transactions. Theoretically, we should not allow trading, period, in any kind of commodities unless you are a manufacturer, distributor, or an end user. There should not be this kind of speculation allowed that causes all of us misery from time to time when prices get wacky or you have shortages and that kind of thing. So yeah, there's a lot of stuff that should be, but it's not, because we have a fractional reserve system that requires never-ending means of finding more ways to blow bubbles. The next one, as we've discussed already, may not be the only one, is going to be this infrastructure spending. And believe you me, when they come up with this, Cory, up in Canada, Trudeau just announced an infrastructure bank up there. Everybody's going to be doing this. So, and you watch what they do with this. You'll not only have the infrastructure banks, you'll have securitization, you'll have derivatives, you'll have all different kind of new stuff on top of it to blow the bubbles even bigger, because they have no choice but to do something like that.
They do, and that's the direction, you're right, that countries are going in. Canada, with Trudeau, has already announced that. But Doc, to one of your points, and quickly touching on this, you're saying that there's so much debt in the U.S., and you know what, I feel like we've been talking about too much debt for years and years and years. Why will this most recent future debt bubble that we all see coming, why will this be the last one?
There's going to be a last one if we don't get this under control. We don't know when it's going to happen, but it is. And what's so scary is that what Chris just mentioned about Canada, but others that will try to do anything to stimulate their economy because of low growth. But there's going to be a time down the road where eventually the bond market isn't going to allow it. And when that happens, it's going to be Katie bar the door. I also know, though, that if they start stimulating like this in this next year, that all I've got to say is this is a different subject, you better be in gold. You better be in the precious metals, because when all this money starts to move and the velocity starts picking up, that's when you're probably going to see the inflation that we've all been expecting for quite a while. And gold is going to be the place to be at that point in time.
Okay, guys, we will talk about gold, but let's stick one final point on the U.S. markets. There was a question from Bob that was sent in earlier before the interview or before this webinar started, and he said the rally since Wednesday has taken a lot of people by surprise. Is this rally now simply going to get away from us and just continue upwards, or will we see some kind of pullback, i.e. gap ups being filled before the market settles into a more balanced move upward over the months ahead? What are we going to see? Is this going to get away from us? It almost sounds like Bob's wondering if he needs to chase the markets higher.
I think you need to be careful about what you chase. I think you need to make the decision of, okay, let's get this noise of the last 48 hours or so out of the way and make whatever assumptions we can for the longer term. Assumption number one is that base metals, and I said this earlier today, the likelihood is that base metals and other commodities for at least the near term will outperform gold. So I'll take, and I don't want to put words in his mouth, I'll take a little bit of the other side of what Doc just said, because I think for the time being gold relative to the other commodities is going to underperform. Go back and look at what happened in 1980, and I think just as I've said, we're going to have stagflation light as we did in the 70s. We're going to have a Reagan boom light under Donald Trump potentially. The patterns might be the same, the extremes might be less, but the pattern back then was, if you remove, which we've now done, the political uncertainty, if you remove the chance of World War III that Hillary Clinton would likely have gotten us into, it's less likely under Trump that wants to work with Russia, wants to either fish or cut bait in the Middle East, etc. Those are two big things as far as drivers for gold specifically as a risk-off asset. And if you believe that the stock market move is going to continue, maybe not in a straight line, maybe things are a little bit goofy right this second, but if you go months or a year or two down the road, chances are doing well, base metals doing well, then look, if you're a portfolio manager, and I said this today, if you're a portfolio manager and you think that you want to invest too much money in gold because of how this will catch up with everything a couple or 3 years down the road, and Doc's right about that, and I believe that same thing. But right now, if you're a money manager and you want to stick in gold and you let the stock market and copper and zinc and aluminum and steel and cyclicals and cement and everything else get away from you, you're going to be replacing the guy that got the infrastructure job at his job back at McDonald's.
I think you're right about that, Chris. I think that's a really good point. I'm just curious about one thing, and it's not really off topic, but Bob, are you Bobby, and did you enjoy that wine that I sent you when I lost the bet to you? Doc, for what it's worth, Bobby is also a retired physician. Very bright.
That was Bob UK that actually asked that question.
Bob
so
UK, great.
That. Doc, getting to what Chris just said there, it is about time frame. Mike actually came in with a question and said, when will we see this velocity that Doc mentioned? Hate to put you on the spot, Doc, but let's hear it.
Well, I always go with charts, and I've been saying for months, and I'll repeat this, and I said this about 2 months ago. First, I said even back a year ago that this recovery in precious metals would be U-shaped, and I've been saying that right along. Now, a couple of months ago, I started to talk about we're going to see a multi-week to multi-month move sideways to down in gold, and we're starting to see that. I think that 2016, as I mentioned before, was a transitional year for the precious metals, and that 2017, according to my charts, weren't going to do much for the precious metals. And I stand by that. The year you've got to watch, I believe, start to watch carefully for the move in precious metals will be the year 2018. Now that goes along with Chris's scenario about base metals. But that's what my charts are telling me, that don't get excited about precious metals again until the year 2018 or the end of 2017. It may start, but it's not going to be the first part of 2017. I think I agree with Chris about base metals and infrastructure plays. That's what's going to be on these buyers' minds now. They're going to forget about gold. Silver might overperform gold, but because it's an industrial metal, but they're not going to be interested in the precious metals for a while until you start to see inflation pick up. Because if this is successful with all their stimulation coming up, you're finally going to see the inflation, I feel.
But this is such a change, right? If 2017 is the year of the base metals and more money going into infrastructure, that does usually support some form of inflation, does it not, Chris?
Well, eventually it does, and a lot of that is, as Doc pointed out, do we see the velocity of money finally pick up? Do we see spending? I mean, as I quipped a little bit ago, because Donald Trump is president and has a lot of bluster, and he's going to get things done, and he's the I love debt president, we're going to make America great and all that, how much can that change, at least right away, the habits that Americans have got used to now since 2008, 2009, and that is to be a little bit more frugal, to pay down debt. Is everybody going to go nutso again with their charge cards? just because Donald Trump is president, and we're hoping we're going to do what he's going to set an example of or try to set an example of, and we're going to go out and borrow from the future again more in the hope that everything is going to catch up to us. I don't know. And I want to point out, too, folks, real quick, that this is not all a done deal. We'll get little dribs and drabs of this, but if you look at the most likely things to be done under a new Trump administration and with Republican control of Congress even, don't hold your breath. Obamacare is totally repealed. I hate to burst your bubble, but you're going to have a lot of tweaking. They'll get rid of the tax on medical devices, which even Hillary Clinton said she was in favor of. They're going to tinker at the margins, but this is like a lot of things in the big welfare state that has been grown for decades. You have something come along, everybody gets used to it, the pain is too great, so they'll make some changes and declare victory. So I don't know what we're going to get out of that yet. The drug stocks have popped, the biotech stocks have popped, that's all good. But if you're looking, and I talked about this before the election when we talked about different possible scenarios, the hospitals, the insurers, that's still a real gray area. And let's not forget also that a good number of these Republicans on Capitol Hill, especially in the House, are not going to take too kindly to forecasts that we're going to immediately, right out of the gate, double Barack Obama's last deficits. So there may be some pushback on just how much of this that we get. They'll find a way to fund it. That's where the corporate tax cut will come in. I think that's a slam dunk, that we're going to have that, and we're going to see some money repatriated. Beyond that, it's going to be interesting to see just how much of this comes about. We'll get some, but I don't know that everybody can just go bat you-know-what crazy quite yet.
Guys, there's another topic that I do want to talk about that we did get a couple questions on, and that is, what do you think the direction of interest rates will be? Because we've already talked about debt. If interest rates go up, is this debt completely unserviceable? We do know that Trump is a debt guy. He's built his wealth on debt, and you know what, debt can be productive if you build productive assets, but debt can also be very harmful. Al, Doc, what do you guys have to say about the future of interest rates under Trump?
Yeah, let me just throw out an opinion on that one. I think one of the reasons that interest rates really got out of hand in terms of going down lower is because I think that the consensus among the quote-unquote powers to be, whoever the heck that is, basically felt that that would stimulate the economy because people would go out and they would basically spend money they didn't have. And is Trump going to continue that particular philosophy at the low interest rate level, or are interest rates are they going to rise as they should if it were a free market? I don't think you're going to see higher interest rates at all, for the logical reason that purely and simply, number one, it's not going to stimulate any spending, and number two, it's going to cripple the government.
Doctor, you have an opinion?
I would agree with that, because if they start to stimulate, and eventually you're going to get a move in rates, there's going to have to be a hand-to-hand relationship with the monetary powers to make sure that rates don't get out of hand. Because if they get out of hand, your discretionary spending by government is going to be really compromised, and they won't allow that. And so if you get the fiscal stimulation we're talking about and rates start to move up, which they should, I think that the Fed, being the non-independent group they are, will be forced to make some moves to keep rates down. I don't see how they can avoid it.
Chris, your comments on rates, considering we have seen a spike in treasuries, in the yields there.
We've seen a spike in treasuries. We're still about 12 or 14 basis points below where we started the year on long-term interest rates, number one. Number two, we are right at, as Dana Lyons, our friend, put out in a chart today, we're right at the downtrend line, going back several years for long-term interest rates. We may push above that a little bit. I don't think that we're going to see a massive move up higher in interest rates for a variety of reasons. Not only what Al and Doc said, but consider, first of all, I don't think the issue of at least federal government debt is that big a deal, because the Fed can monetize whatever they want at whatever rate they want and just blow it off. So that part doesn't worry me. What does worry me, and what I have to question aloud, is what happens when you've got things just almost dead in the water, very, very slow growth in the economy now. Do you make things better if market interest rates go up and it costs more for a new car for those that are still in the market for one, or it costs more for mortgage for people that can afford housing after this recent run-up in prices that we've had, this rebound? So again, for a variety of reasons, I think that the move up in interest rates is going to be self-limiting. And that later on, whatever the time frame is, a year, 2 years, whatever, I don't know. And I'm not saying be entirely out of gold, but when it's really going to catch fire is when we get past this initial phase, in whatever form it is, where we're going to have this modestly inflationary growth, the reflation, better velocity of money, the base metals, the other commodities do better, the stock market goes gangbusters for a while, and then all of a sudden that flames out. And it's going to flame out a lot faster than it did in the 80s. And when the Fed, in spite of that ramp up in inflation, still is afraid to raise rates too much because of the nature of the fractional reserve system, that later on is when the precious metals will regain the lead.
Well,
I want to
to
make
your point
this
there.
is one quick, if you don't mind. This is just housekeeping, Cory, and nothing else. LPG, you're sending me an awful lot of comments right now, and those are all very good comments. You're sending them on Skype, so it's kind of hard for me to jump in here in this particular environment. But I would like to see you put those comments up as you can, and then Cory, I'm sure, would like to have everyone address those. Sorry, Cory.
I have not seen. Yeah, LPG sent me something earlier, and that's when I brought up that 15% tax rate. But Chris, back to what you said about the government being able to continue to issue debt. Jim said the country went from $4 trillion in debt to $20 trillion in 8 years under Obama. So you know what? The ceiling does keep on getting raised. Another comment about gold, though, that let's have you guys address this is Stan Druckenmiller, sold all of his gold assets after the election results came in. He's expecting the dollar to rise. That's historically not good for gold. Chris, what do you say to Stan after he did that?
He did it for the same reasons that I just said a few minutes ago. You're going to have the stock market and cyclical stuff doing better. I don't think it's all because the dollar is rising, but again, you've got a lot of the uncertainty removed, the fear, the worries about any major war with Russia and whatnot removed. We're going to have better relations and cooperation with other nations. So for at least the time being, the reasons to own gold changed, and not for the better after this election.
Doc, your comments, because we are seeing the U.S. dollar continue to move up. We touched on it briefly at the market close, but that is another reason to be a bit hesitant on gold, and maybe that's why you think 2018 is the year.
Yeah, and Chris brings up fundamental reasons why, and he's correct. And I look at the technicals, and they verify what Chris is saying. And I think a lot of these precious metal stocks will continue to sell off. As they sell off, I don't think they're going to reach the lows a lot of them hit before, but they're going to continue to sell off, and I think it's going to be a great time to buy. But that's going to be a number of weeks down the road, and they'll get down to another bottom, and then they'll hit a trading range, and that's when people better start accumulating them again, because I think we're going to see a lot of them do a double bottom, but the low is going to be a little higher than the lows that they hit before we took off back in the end of 2015. But you better expect it, because if you look at when you look at gold when it hit its low at the end of 2015, gold's going to move back down, and it's going to do it very similar to the move down to its lows. It's not going to be as long a slide, but it's going to move back down, and then you better be ready, because you better be in that market. I might make another point as far as inflation. You have to remember that commodities don't impact inflation much. It's wage increases that really impact inflation. So you can have a move in these commodities and not get much inflation. But it's going to be after that happens, if it stimulates more employment and it starts to put pressure on the employment picture, that's when you're going to get the wage increases finally, I think. And that's cost push inflation, which always extends inflation more than demand pull inflation. So that's the scenario I'm looking at fundamentally down the road.
Now, Doc, this obviously will take time to develop, but I think you do bring up a good point there. On to LPG's comments that he, I guess, was sending you, Al. His comment was rates on the 10-year have been low because mostly growth has been low and inflation muted. Rates reflect both growth expectations and inflation expectations. If growth ticks up, yields on the 10-year will move higher. The market will price this. What do you have to say about that, Chris? Let's go with.
Well, those are all elements. The other big element, of course, is that you've had price suppression. I mean, people that want to talk about the plunge protection team and the cartel and all of that when it comes to the metals, that's a pimple on a flea compared to the price suppression that you've had on treasuries, meaning the price as far as the interest rates are concerned. In order for me to get all out bearish on treasuries, I would need to be convinced that the central banks are all going to stand back, let nature take its course. If it did, we'd get to Greenspan's target of 5% on a 10-year treasury next week. That ain't going to happen. All right. And the other thing that you've got to consider right now, and this is one of the reasons why up to now the Fed has had a lot of help in keeping interest rates suppressed on U.S. Treasury paper here, is that it's been so much lower elsewhere. And at what point, with the dollar soaring, with the other currencies going down, are you going to see a situation where you've got big demand for treasuries again? That also is going to be one of the limiting factors in keeping this sell-off in treasuries and the rise in yields fairly limited. That's one of the patterns of the early 80s. One of the things that helped to bring down interest rates very quickly and helped to fuel the stock market rally despite the deficit going into orbit in relative terms back then was because with the rise in the dollar, you had things really get out of hand. And the whole world was putting money in U.S. dollars and treasuries and stocks, you name it. And it got to such an extreme as far as hurting everything else and upsetting the balance of payments and trade that you had, the U.S. finally had to cry uncle. And what did you have in 1985 as a result of that, Doc? Remember? The Plaza Accord.
Oh, yeah, that's right. Mm-hmm.
Where they said enough. Well, it ain't going to take 5 years for it to happen this time, folks. No. And I'll tell you one of the things to watch right now, and the Fed has got to be sweating bullets over the dollar index getting back up near 100 and everything else. Look at what emerging markets did in the last day or two. Did they join in this party? No, they got their butts kicked today. And it's going to get worse the longer this goes on, and that won't be tolerable either. So you've got a lot of these irresistible market forces with people lurching these certain ways that are going to hit these immovable objects, and it's going to be, one of them's going to give.
Yeah, and you're right, Chris, and that's a great point because we were talking earlier, Cory, today about how, up to this point, the dollar is the best-looking kid on the block because the other currencies are so lousy and their economies are so poor. And if you get the kind of stimulation we're talking about and potential growth, the dollar is going to soar because now people get back into it because they're looking at it being the not a safe haven, but the fact that our economy is going to grow like crazy. And then that's going to really hurt those other currencies. So we're in a transition here potentially.
Great point.
Well, I want to ask you one question.
That's what we need to look at with the dollar now. That's exactly the right way to put it, Doc. This is going to be a big growth story now. Everybody's going to want the dollar, and it's going to cause a lot of problems like it did in the 80s, but a whole lot faster if this keeps going.
I agree.
Here's an interesting caveat, though, you guys, and just I think this is worth considering. I really do. I think that the motives, for lack of better terms, behind the numbers that were coming out and the economic actions that were taken under the past 8 years, the administration of the past 8 years, the Obama administration, I think that a lot of the things that came out, a lot of the actions that were taken primarily not necessarily to stimulate, not necessarily to make things better, but perhaps to instill more confidence in the government, instill more confidence in the economy. To me, that's a bit of a sideshow. To me, that's a bit of a, you're not really telling the truth because you want to look good, for lack of better terms. I don't think the current administration, and I don't believe that the current Congress is going to be doing that same thing. I would go so far as to say, I really wonder, for example, if the employment numbers that we see coming out in the future are not perhaps going to be a little bit more realistic, not going to be couched by, I don't want to use the word irrelevant, but I guess I would have to say that almost irrelevant information. I think we're going to see a different tact being taken in the new administration personally, and I think that's going to be a more effective tact.
Yeah,
Hmm?
yeah, I think the administration going forward, and I think the Congress, along with the president, what their focus is going to be on is on the middle class. They've got to raise the middle class up. Again, they are hurting. They're being squeezed with wages that haven't gone up comparative to inflation. Their median incomes have been hurt for 16 years. Then you throw Obamacare on top of it and increasing premiums. They are getting squeezed so badly, and more of them are dropping into the poverty level than they're being raised up. And I think they're going to focus on this inequality thing, you might say, and they're going to try to do as much as they can to take the pressure off the middle class. That's their only hope, I feel. And I think
Only
that's
hope
where,
for what? Only hope for what, Doc?
for this country. And I think if they don't help stabilize and raise up the middle class again, we're going to move into a more of a two-class system. They realize it, and they know that this is their chance to hopefully help those people, because that's where your demand's going to come from ultimately too. And I think that's going to be a big focus on this administration, frankly.
Now, Chris, what do you think? Do you think this administration will focus on the middle class? Trump seems to be getting a lot of that support, so will he follow through with that? Will government enable those actions, even the central bank?
I think so, Cory, and I don't want to sound, when I was talking about some of the little battles that are to come, I don't want to be completely pessimistic. Tax reform is a great thing. Regulations that have come about in the last 8 years, most of them have been pushed by academics and policy wonks who have utterly no understanding of economics. They've done terrible harm to this country. People, Republican and Democrat alike, acknowledge that. And so that's going to be a breath of fresh air. Here's where I come down on this. It's questionable in a major sense just how much anything at this particular point in time that happens is going to resurrect the middle class in a big way. I think some people's lot in life will be better. I don't know that we're going to get income tax reform that would help a lot of middle Americans, but we're going to get at least some of the supply side type of stuff that to a great extent did work under Reagan. What caused the deficits was that at the same time the economy was growing and tax receipts were growing from what happened under Reagan, the size of government exploded. And so we lost all of the benefit of the better economy and the higher tax revenues that came in even with lower tax rates. I hope that the current mix of a President Trump and the Republicans on Capitol Hill won't make that same mistake and will find ways to at least half pay for some of this stuff that they're talking about doing. They can justify it with the corporate tax cut. They can justify it by finding ways to encourage the repatriation of a couple of $1 trillion that's outside our shores, etc. Hopefully they do all that. But does that all change sufficiently the fact that we already have massive tens of trillions of dollars in public and private debt now that has become so stifling that even if we get all of these great benefits from what Trump and the Congress want to do, and I applaud them, I'm encouraging, I pray for them, I hope they do all this, is it going to give us anything more than a blip? You know, you mentioned Druckenmiller, Cory. One of the things he said today, and I think was very realistic, is there is the potential, you know, Trump said he's going to give us 6 or 7% growth. All right, well, that's like saying he's going to build a wall. There's not going to be a wall. Write it down. Don't buy cement stocks because you think there's going to be a wall at the Rio Grande River, because there's not. But when you look at the realistic assessment, Druckenmiller, who's a smart guy, said there's the potential that if everything fires on all cylinders and we get some good boost to growth from all of these things that are being suggested, maybe for about 18 months you get a 4% growth rate. And then we're back in a lethargy, and okay, how do we digest all this and how do we grow from that? If it's going to be based on that, very good observation I think he made. And that's something that maybe you can realistically expect in a best case scenario.
Well, Chris, back to Druckenmiller's comment and back to your comment, we've had a couple other questions come in that talk about the U.S. dollar. And I think the U.S. dollar is crucial here because it does continue to move up. And you look at not only Trump's policies of bringing business back to the U.S. and repatriating the U.S. dollars that are offshore, 2 to 3 trillion, as LPG says. If these 2 to 3 trillion of U.S. dollars come back to the U.S., that means a bunch of foreign currencies will have to be sold to get these dollars. Mike also makes the comment that if we continue to see the EU struggle and Japan struggle that might experience negative results due to global deflation, that's going to lead to even more of a flight to the U.S. dollar. It seems like we all agree. Mike asks, would we agree with that? I think that's in the cards, and I could see, who knows, maybe Rick's comment, the dollar at 120 is much closer than we thought a couple weeks ago.
I'm a lot bigger believer right now, Cory, in that possibility than I was prior to the election. I'll tell you that much.
Doc, it sounds like you're seeing a lot of potential for the U.S. dollar to keep going up, more importantly, for the right reasons.
Yeah, I agree with that. And that's a huge danger. Yeah, I don't know how they're going to work that out, frankly. But it's going to be some machinations we're going to watch over the next few months as they make their decisions in the first 100 days of that administration. And how they're going to handle an expanding dollar, I'm going to watch that with interest because that's a real dilemma. And there are going to be countries that are just going to scream if that happens, and you can't get away with it. So, but that's what happens when you no longer have free markets and you continually try to manipulate them to try to maintain a fake economy or an artificial economy. You get into these crises and they're going to keep coming at us until we get back to a real economy. And that's why I agree with Chris that strengthening dollar is going to be a huge dilemma for this administration.
But now to your point, yeah, go for it, Chris. Sorry, I'll jump in.
We may end up having to have a depends accord because Mrs. Yellen's going to go through so many pairs of them worrying about this that she'll cry uncle.
So is this a bad strategy then to try to bring everything back to the U.S. to try to spur U.S. growth if we are going to have this dollar? Because maybe bringing everything back to the U.S. could help this middle class, but it is cutting off this globalism type of trend that we've seen where you do need to work with other countries to continue to advance, don't you?
Yes, and that, ironically, Cory, could be one of the things that continues to fragment some of the world and some of this global trade, is if you have the dollar so strong it causes so much trouble elsewhere that you have people start to pull away again. I mean, in one sense, we shouldn't even be talking about this because we had a new world currency unveiled September 30th, and we're not going to talk about the dollar anymore anyway, I suppose, right? But no, seriously.
Chris, the
Um,
flying saucer got away.
but anyways, I think yeah, this is going to be a big issue, and what it does to emerging markets, it's going to punish them even more. And yeah, I've been believing for a long time that instead of some other currency coming to replace the dollar is always going to be around. It's going to be around for a long time to come. But there are going to be other regional currencies where, out of necessity, you have this, and we may see the necessity take greater root now if things get so far out of whack with the dollar or whatever else that maybe we're not even thinking of, that the price to pay, especially for emerging markets to use it, is just going to be too high, and they won't use it.
Okay, guys, we only have 10 minutes left here. I want to get to a couple more questions. However, one just came in from Mike that I think needs to be touched on, and Doc, you and I did touch on this. So, Chris, let's get your opinion. Small cap stocks, they aren't affected as much by the dollar because they aren't multinational. Should they be looked at in a portfolio right now?
Well, I think some should, and especially because they got beaten up pretty good right before the election because people having worries about how much worse the domestic economy might get if we'd had a different electoral outcome. So, yeah, I think there's a lot of good small cap stocks to look at. There's a lot of good infrastructure stocks to look at. There's a lot of good healthcare, drug, biotech stocks to look at. A lot of the base metal stocks, I think you got to look at them individually. Some have had big runs. I would like to see a pullback first. I think that we're going to get some better indication of just how strongly, investors think about this whole thesis if we can see oil hold its support, because just like emerging markets, notably energy too, has weakened further in the last couple of days, and it hasn't joined this euphoric party, at least not yet. And you have to consider that with a President Trump now, you've got more incentive for some of these energy companies to keep producing. You're going to have less regulation of them as well. That'll reduce some costs, but it's also going to be one of the other factors that keeps supply up. That might help this whole mix at the same time. So do you want some of the energy producers? Not necessarily. Do you want the service companies that are still cheap? Probably do. One of the ones, I'll throw one name out that I added back to my recommendations not terribly long ago that looks pretty darn good, Matrix Service Company. They service a lot of different parts of the energy industry along the food chain. Very good company, very attractive earnings profile. They've had a nice recovery. That's one you'd want to look at. So, and really, when we think about this, if the oil price does stay down for a while, it makes the rest of this look that much better because there's going to be less inflation pressure. The producers of copper and steel and whatever are going to have lower costs as a result of this. Another theme is to look not so much at U.S.-based ones, but Canadian-based ones, ones based in South America or countries that don't use the dollar, because you're going to have cheaper expenses for them in comparison to what it would be if they were operating here. So there's a lot of different ways that this can be played, and thankfully, in the majority of the cases that I just mentioned, these are all stocks that for the last 2 or 3 years nobody wanted.
Exactly. We very well could be seeing the next bubble come from the sectors that were beat up so much in the last 5 years. One other random question that came in here, and Wayne, I don't mean to say it's random, but in the way that we have been talking, something we haven't talked about in a long time. I don't think we need to spend too much time on it, but along with the election, there on the ballot were some other issues, one being legalizing marijuana. It was legalized, I believe, in 4 more states, California being one of them. Should we be looking at the marijuana space for investing? Doc, you're a doctor. Let's not get a doctor's opinion on this, but from an investor, what do you think?
Well, Cory, I don't know a lot about recreational use of marijuana. Unfortunately, I guess I can from a physician standpoint. And there are so many ways of treating different things. And marijuana is a positive for some of them, but unfortunately not for a lot of conditions. So you have a legitimate use for some small number of diagnoses potentially, but then everybody's going to, of course, have those diagnoses if they need to get the drug. But as far as the recreational use, yeah, I'm not really into marijuana, never have been, frankly. And
but it's a big market, Doc, or it has the potential to be a big market. When you do start to legalize something, there has to be some investment opportunity.
Oh, there is. There's no question about that. And you know, that's an area I haven't really looked into from an investment standpoint. But the thing is, I think one of the reasons we're seeing all this legalization is not so much that the government wants it to happen because it's for the good of the people, but from a tax standpoint, they need to get revenues any way they can. And so they're willing to do anything to get revenues, and I think that's why you're not seeing a lot of pushback on marijuana actually by actually the government today anymore, which you would have in the past.
Yeah, just one quick comment on that. You know, in the area that we live in, we have marijuana is very, very, very easy to get up here, and I just happen to like, as Cory unfortunately knows only too well, I just really like good red wine. A little more expensive, but that's okay. I think the growth curve, Cory, is probably going to be, I don't think it's going to happen quickly. I think eventually marijuana is probably going to, you know, rival, maybe not rival, but certainly be in the same category to a larger extent than it is now, you know, of the liquor industry, wine, beer, spirits, etc. But it's not quite there yet, but I think it will be.
Oh, there's potentially a huge market out there. It's just hard to determine where the stocks are, and we've already seen some investments that have been good for some people and also been very tough to get through, especially when you're dealing border to border too.
Mm-hmm. Well, Cory, to me, it's kind of like the internet stocks when they first came about. More recently, the lithium stocks. You got lots of companies out there claiming that they've got a piece of this, and they're the next big thing. Most of them won't be. I don't claim to be an expert either. What I do, and I'm not an expert, is I look for somebody who is. So one of the next actually companies I'm recommending shortly to my members is a company that is basically a basket of the stocks in the cannabis area that they have researched. I'll let somebody that knows what they're doing make the decision and look at it as a small sector play. There's a couple other ones I'm looking at, but again, sometimes the information's sketchy. There's a few of them in some cases that have already run to the moon. There's some that act like they should have run to the moon that haven't. And again, you know, we can only individually follow so much. But I did run across this one company. I'm talking to them tomorrow. And I'm pretty jazzed about the idea of, if you're going to put your toe in the water in any way in this space, that it be done by somebody that knows what they're doing. They've got some money to put to work themselves, and they spread it out among the plays that they've researched and that they know are good.
Well, one final comment on this too. We do need to understand that marijuana, in a sense, it's not like going out and finding a gold mine. Technically, anybody can grow this stuff if you are to market, and I believe if you market it properly, then you're going to do very well. But I think it's going to turn into a big corporation, much like the alcohol industry, where technically I can go to my kitchen and make beer. It probably won't be as good, and who knows how it'll turn out. Actually, I have done that, and it turned out pretty good. But I'm not bringing it to market. You need big companies that can have the distribution. It's very different than other commodities. A final comment that we are going to end on here. We only have enough for maybe about 30 seconds each. Final question that came in from Brian. Will Donald Trump default on some or any of the debt?
No.
Doc?
I agree with that. I would not think so.
Al?
No, absolutely not. Only because it would be a very poor show for him to do that in the first term. In the second term, I'd say possibly, because somebody is going to default on it eventually. We'll see how much of a realist he is. It's not going to happen in the near future, though, in my opinion.
I don't think he will either. I think it is one of those where they're just going to keep on printing money. They have done that in the past. They're going to continue doing that. Everybody, I hope you enjoyed this webinar. It was a lot of fun, the roundtable aspect. Thank you for everyone's questions, the back and forth that we got. If you have any more recommendations, any more ideas for webinars, always email me, fleck@kereport.com. Thanks again for joining in, everybody.